Interesting research, and an area that absolutely needs the research, is the area of how much someone should be invested prior to and during their retirement, and the impact that this potentially can have on their retirement outcomes. The research, which I've linked down below, challenges two key areas. The first of which is that investors should diversify across a combination of equities and bonds, and the second that being older means you should hold less equities than someone younger. The research is US based, but does reference that the outcome with the equivalent mix of equities would give the same result. The basis of this research is that as we get older, the general tenet is that we should diversify across equities and bonds, and that this allocation to fixed interest should increase the older we get. Clearly, this was tested to destruction when those holding default lifestyle strategies saw significant declines in the value of their pensions. In some cases, individuals are automatically placed into a retirement plan, for example, which has a 75% allocation to gilts and 25% allocation to cash. The theory behind some of these default lifestyle strategies is that they de-risk the pension as you approach your selected retirement date, with the intention that the pension plan will be used to buy an annuity within 12 months of this selected retirement date, which for most people is not at all likely. The result of this is de-risking was then to push those into a very high allocation of gilts at the worst possible time of Liz Truss announcing her mini budget, and then the follow-up with the Bank of England increasing interest rates. As an example, one of these funds with a 75% long gilt and 25% cash exposure lost 41% of its value over a 3-year period. Not exactly low risk and not exactly low volatility. In many cases, this default and lifestyle funds are simply not appropriate given that a significant number of retirees aren't retiring at the selected retirement dates and are using flexi access drawdown and not buying annuities. And outside of the lifestyle funds, there is a heavy prevalence of the use of balanced funds for the default fund option and a significant amount of workplace pension arrangements. A default fund must be selected by the workplace arrangement, but clearly a balanced default solution will likely only be appropriate for a small minority of individuals. This is where it is critical that we ensure that we are aware of how and into what our money is invested, and whether it aligns with our overall objectives, both in terms of how much risk and volatility we are prepared to experience. Stating the obvious here, but the returns of the underlying investments is critical to the success or failure of meeting someone's objectives up to and over the course of their retirement. The key part of this is the importance of the fund to meet their income needs for the duration of the retirement, and importantly, not outlive their pension pot. Coming back to the research, critically, it determined that a simple strategy of investing 50% into domestic shares, bear in mind that this is a US based, although it does reference the approach that should be taken in other countries, and 50% in international shares throughout someone's lifetime and for the entirety of their retirement, that the portfolio would provide the best outcome at generating more wealth at retirement and is less likely to exhaust savings and more likely to leave a large inheritance. The researchers came to this conclusion by using market data going back all the way to the 1890s. They simulated the financial lives of 1 million couples from 39 countries who start saving 10% of their salary from the age of 25 until their retirement at age 65. When they retire, each couple withdraws 4% of their savings indexed to inflation until the death of the second spouse. The simulations consider market fluctuations, mortality risk, and the risk of redundancy, as well as the buffer provided by state pensions. They compare the following strategies in both pre- and post-retirement: 100% government bonds, 60% stocks, 40% bonds, 100% stocks at 25 with a gradual shift to bonds over time, and 100% domestic stocks, and 50% domestic stocks and 50% international stocks. And that if based outside the US, then the investor should allocate 35% to their domestic market and 65% to international stocks to achieve the same outcome. On average, the researchers found 100% exposure using the domestic and international split produced some 30% more at retirement than stocks and bonds combined. And to achieve the same amount of money at retirement, an investor gradually blending into bonds would need to save 40% more than an all equity investor, which, to be fair, shouldn't come as a massive surprise to anyone. However, what was surprising was just how significant the variation in outcomes is. The key part of this is that even in retirement, the outcome by investing 100% into equities was superior to being diversified into fixed income. That despite the significant drawdowns that can occur, the retirement outcomes are all more favorable with the high allocation to equities. And crucially, the researchers state that retirement savers and retirees may be rightfully concerned about the possibility that the stock market will perform poorly during their lifetime, but that concerningly, when domestic equities does perform poorly, bonds and bills also tend to perform poorly too. Fixed income does not offer an adequate haven against poor equity outcomes over the long run. The researchers' point of view is that investors should accept the volatility and short-term losses on the basis that in doing so will achieve a far greater outcome, and they are more likely to succeed in taking a 100% domestic and international stocks approach. That a key part of the success is in the mitigation of inflation, which is primarily achieved by having the international equity exposure. But this strategy is, of course, not without its risks, and clearly the significant one of large drawdowns, especially in retirement when drawing on that portfolio. A key concern for anyone drawing on an invested portfolio is that of two factors. One is sequence of returns risk, and the other is volatility drag. And I have a really nice example of this. So we've got a pension pot of £200,000, and we're just going to I'm going to show you two scenarios, and this is really going to demonstrate sequence of returns risk and volatility drag over this 20-year period. So we've got £200,000, we're taking out a fixed amount, £7,000 a year, which is about 3.5% of that starting level of invested money. Now, if we're taking out 3.5% per year, and let's say our return is this wonderful 3.5% a year every single year in a linear fashion, then we're going to be very comfortable to say that our £200,000 isn't going to fall in value. Why? Because, of course, we've got our £200,000, it grows by 3.5%, and then we take that 3.5% out as an income at the end of the year, and then in the following year it grows by another 3.5%, £7,000, and then we take that out, and that can carry on all the way through to year 20, and we've still got our original nominal £200,000 that we put in there. So let's jump over then to scenario 1, where we've got our very poor level of returns early on, and then we've got our higher levels of return that happens in the second half of that 10-year period. So you'll see straight away that big hit in the first year, we've got a big decline of minus 15.83%, and we're taking our £7,000 off at the end of that year. So we've got a big decline. So in that following year, we've another minus 13%, and then we're taking another £7,000 of income off of that year as well. And you'll see the dramatic impact that this has in terms of having those very poor returns early on, and even though we've got these improved returns later on, it's not enough to be able to rebuild our fund back up. And so crucially, what's happening here is actually we've got 3.5% annualized investment return over this period, and we've got 3.5% annualized return over this period. Got exactly the same annualized investment return, but because we've got these very poor investment returns early on, which results in the significant reduction in the fund value early on in the retirement, but we're taking an income from it as well. So the impact of that is that what is known as volatility drag, which is this issue around how much you need to then get as a return to be able to bring you back up to the original percentage. So by way of example, if the fund value was to fall by 30%, you would effectively need 43% to get you back to your original value. And that gets worse. The larger the percentage fall, the bigger the percentage you need to get back to your original value. And that's what's happening in those very early years. And it just simply isn't enough. Even though we've got the same annualized investment return over the whole period, the same investment annualized return in scenario 2, we're still not able to get back to our original £200,000 because of those early years. So this is where some degree of management, of consideration needs to come into this, as far as this could be a potential risk for somebody as far as the volatility is concerned when we're drawing on that pension fund. So you need to think about how best to mitigate and manage this position prior to drawing down on it, whether that's allocating to cash, whether it's thinking about how much volatility you're comfortable with, or whether you have enough secure income elsewhere where you can manage this level of fixed income, so you actually have to reduce the level of income that's been taken over those earlier years, and that you're going to be comfortable with that position. And this broadly aligns with Morningstar's research that shows portfolios with high equity allocations delivered superior returns and in turn higher safe withdrawal rates than those with more conservative positioning. Portfolios with 100% equity weightings delivered the highest starting safe withdrawal percentage over any 30-year period in history at 6.9%, but in less forgiving environments, even a 2% starting withdrawal rate could have been too risky. Another concern with this strategy is simply of human behavior and psychology. Simply put, our ability to be comfortable with volatility, with market events, and to hold our position during those periods of time. We must be honest with ourselves as to how comfortable we are with volatility, that the volatility essentially is the cost of achieving those potential higher rates of return. Will we really be comfortable remaining invested when markets suffer significant falls in value, and do we have the financial security to weather those periods of time should we need to? If we have plenty of secure guaranteed incomes, the majority of which meets our required expenses, then perhaps we can accept greater risk and volatility from our invested pension portfolio, or that we are comfortable to flexibly adjust our income in line with the value of our funds should we need to, and that our living standard won't be adversely impacted by any decreases that could be required. I hope that you found that interesting, and I'll see you again soon. Cheers.